Welcome to this Killick Explains Finance video. This week, a topic that I've addressed before, but from a slightly different angle and using slightly different data, how stock markets have foxed the forecasters. The old cliche says what goes up must come down and vice versa. Mean reversion fans say at the end of the day things must revert to their long-term mean. And whilst I don't disagree, that's not terribly useful when it comes to deciding what you think is going to happen in the stock market next. Here's why. Now basically the background is this. 2019 was a very strong year for the S&P 500. In local currency terms, dollar terms, it went up around 30% between the 1st of January and the 31st of December. And if you were fortunate enough to be an overseas investor investing in a weak pound versus strong dollar, you might have done even better than that. But what does that say about 2020? And the answer is actually not very much in either direction. It's dangerous to base any forecast simply on those facts. Yes, that was a spectacular year. Yes, well above the average annual return you'd expect, as I'll come back to in a moment, but that doesn't necessarily tell you what will happen next, and therefore is not something I would spend a lot of time worrying about. Now, will gravity take over? That's the question everyone's been asking for several years now. This most hated bull run of the last few years, with an enormous kicker year last year, surely that has to end badly and soon. Well, mean reversion theory says that above average returns have to eventually come down to nearer the average. In the mix there, some below average returns as well. In other words, things revert their long-term trend. The problem is calling both the timing and the extent of any correction that gets us back there. And the quickest way to see this is via some data. Now, I'm grateful to Ben Carlson, a wealth of common sense, for what's about to follow, a snapshot. I'm going to use the biggest stock market in the world, the S&P 500, going back to 1926, so a pretty comprehensive data set. The key question, can the past reliably indicate the short-term future? And the answer is not really. And this data set will hopefully reveal why, and therefore the danger of relying on gurus who say, well, based on my analysis, this is what's going to happen in 2020. I very much doubt the analysis holds sway. So here it is, bit of a beast of a chart. What's it trying to show? S&P 500 average return since 1926 at the top there. And what it's trying to do is to say, right, overall, so yes, 2019 was pretty spectacular. 30% is in no way normal for a one-year consistent performance. In nominal terms, if you like, not inflation adjusted, you might be looking at a typical year at a total return of around 12%. Decent, but well below the 30 from 2019. That's an average. Now, what are we trying to say here? What we're trying to say is, yes, 30% was spectacular in 2019, but does that give us any sense of where things will go next? The fact there was a big return last year, does that tell us anything? And what this data suggests is not an awful lot about 2020, because what this is saying is after an up year of any size, the S&P 500 normally turns in around its average performance. After a down year of any size, it also often turns in, on average, a positive performance. And if you get a monster year, defined only not as 30% gains, but as 10% plus gains, on average, you get a positive gain the following year. If you get a down year, a big down year, you still get, on average, a positive return the following year. And after a small gain or loss, ironically, you actually get, on average, a larger overall increase the following year. So what are we concluding from this? We're saying it's quite hard really to draw any meaningful conclusion from a one-year performance about the next year. Whether that one-year performance is up a bit, down a bit, up a lot, down a lot. But what we can do is draw some broad conclusions about the way the S&P has tended to behave in the past, which might be useful going forward. So, some key facts coming up. US stocks have been up 10% plus. Okay, remember that from the chart, 54 times since 1926. So we're focusing now on the good years, if you like, because 2019 was a good one and people are looking forward to 2020. The average return following one of those years was 11.5% on both a mean and median basis for average fans out there. Following year return was positive 72% at the time and negative 28% at the time. So what are we saying there? We're saying actually just saying because the market went up strongly last year, it must go down and probably strongly this year is not a valid conclusion to draw. Out of those 54 times, going back to the previous slide, 29% the following years were 10% plus gainers, big years. Only 3 10% loss years immediately followed a 10% gain year in the years in brackets there. So what we're saying is, historically, and I know the past is no guide to the future, some people would say it's dangerous to draw conclusions from the past, but actually you weren't particularly likely to see a big loss year after a big gain year, and that's why forecasters are often wrong. The ones who try to focus on, well, this is what happened last year, this must be what will happen next year. There's no scientific evidence, if you like, from the historic performance of the S&P 500 you can necessarily draw a meaningful conclusion from one year to the next. Longer range, maybe, but not on that timescale. So conclusions would be what from all of this? So stocks have gone up roughly 3 years in 4. That's worth remembering. Yes, we've seen a big bull run, the longest, deepest, arguably, bull run in the S&P 500's history over the last decade, if you're measuring in decades. All right, and that at some point could presage some sort of correction, some sort of dip, law of mean reversion and so on over the long term. But stock markets do tend to rise. A strong year doesn't guarantee a weak one or vice versa. So panicking and saying, well, surely this has to be the end in 2020 may not do you any favours any more than it did the end of 2018 going into 2019, and there were plenty of bears around then too. Average returns tend to be positive regardless of the market backdrop. Now that is not, I stress, not me saying, well, the market's bound to go up in 2020. I'm just saying it's dangerous to draw any conclusions about its behaviour in 2020 simply because of what happened last year. Takeaways then, plan to stay invested. All right, you need a strategy to deal with rainy day problems. You need a strategy to deal with foreseeable calls on capital. I deal with that in other videos, but fundamentally the bulk of your lifetime, long-term, potentially intergenerational savings want to be where they stand the most chance of earning inflation-beating returns within the securities world, and that is the equities market. Be wary of short-term predictions. I've said it before, hopefully the data in this video reinforces the point using the S&P 500. Market trends slow and reverse. That is true. Mean reversion applies to the stock market as much as it does anything else, frankly, but it's unwise to make assumptions about how and when. And it's particularly unwise to make short-term assumptions about how and when, because history suggests they're simply not valid. Find out more about either the data that I presented or the arguments around it, editor@killick.com. And if you'd like to watch some of the videos I've hinted at on why forecasting is dangerous, then it's killick.com/learn. Flick down here and start with the shares tab.